Good morning, good afternoon, or good evening, depending on or where in the world you are watching this video. And welcome to another episode of the OneLegal Talks. For the next 50 or so minutes, I'm going to be talking with Mark Walker about essentially two topics that are very relevant and I would say very, very timely in 2023. One being infrastructure finance, particularly in emerging countries, including in the Africa continent. That's, of course, an area that OneLegal is very focused on. And then also what I would call the less nice side of finance, which is when countries get into severe financial distress and are at risk of defaulting on their obligations and then have to restructure that debt. And there are plenty of countries right now that are in that situation, as we will discuss later. So Mark is in New York office at Guggenheim Securities, where he is Senior Managing Director, Sovereign Advisory. Hi, Mark. Good morning.
Good morning. Pleasure to be here.
Pleasure to have you, and thank you very much for joining me today. And Mark, as I said, is in New York. I hope it's a good day in New York, not very cloudy, not rainy.
No rain. Yesterday we had rain. Today, so far, dry.
Okay, good. Okay, so I normally start by making an introduction of my guest. In the case of Mark, this is particularly difficult because he has a very extensive CV. So I will try to summarize it. So prior to joining Guggenheim Securities, Mark was head of sovereign advisory at Milstein & Co. And before that at Rothschild in London. Before, he was a senior advisor at Lazard in Paris. And before that, and for many years, Mark was a partner at US law firm Clearly Gottlieb, where between 1975 and 2011, if I get it right, and in the last years at Clearly Gottlieb, he was the global managing partner of the firm. He has a law degree from Yale Law School and a Bachelor of Arts in English Literature from Stanford University. Now, Mark has over 40 years of experience advising more than 20 countries around the world. Maybe that this number is no longer updated, but more than 20 countries around the world on very, very complex financial matters, in particular countries that get themselves into financial or debt distress. He also advises countries on infrastructure finance and other related matters. The countries that have benefited from Mark's advice and counsel include Colombia, Indonesia, Ivory Coast, Mexico, Peru, the Philippines, South Korea, etc. Also, Cyprus, where Mark advised during the financial crisis of Cyprus in 2013. Also, Greece in their huge debt restructuring in 2011 and 2012, which I think at the time was the largest sovereign debt restructuring ever. I don't know if that record still holds, but we'll talk about that in a moment. And then he also advises other parties, creditors, including more recently the Venezuela Bondholders Committee. And during the great financial crisis of 2008, which I suspect was a very busy year for you, Mark, 2008, he advised the US Federal Reserve, the Fed, with respect to the bankruptcy of course, Lehman Brothers. So, did I get everything right, Mark?
You did.
Okay, good. Okay, so let's start with infrastructure finance. My first question to you, Mark, is based on your experience working alongside investors in emerging economies, and in particularly in Africa, and in the financing of infrastructure or oil and gas also projects, what would you say are today the main risks and the main challenges that international finance investors and lenders face when they finance projects in these parts of the world?
Right. Well, I think the risks can be, in the first instance, categorized into two separate sets of issues. One is political risk, political issues, and the second, of course, is credit risk. And they're not unrelated, because to the extent political risk comes into play, it impacts credit. But the solutions are different, I think, in large part. But let's start with credit risk. The credit risk could be twofold. Depending on whether the financing is guaranteed by the government or some other domestic entity. It could be the central bank, although that's pretty rare these days, or not guaranteed. And that has an impact on several things. First of all, it has an impact on whether if the country does come into difficulty, whether the financing for the infrastructure project will be caught up in the restructuring or not. It may or may not be, but to the extent there's a government guarantee and the guarantee is critical to the investor getting a return on his money or getting paid, then the likelihood that the project will be caught up in the restructuring is much greater. Even if it's not government guarantee, that may happen. And so there's always a risk. So how do you deal with the credit risk? I think there are two answers. One is external credit enhancement in the form of guarantees or credit insurance or quasi-guarantees from external organizations. They could be from export credit agencies, which also will provide credit. For example, a lot of China's investment overseas, many of which, as we know, are not terribly successful, are insured by Sinosure. So the Chinese banks that make the investments have a credit insurance from for them a domestic credit insurer. But there's also possibility of intervention by multilateral development banks and export credit agencies around the world, or even international financial institutions that provide credit support for credits that are designed to help finance development of the country. So those are important possibilities. It can be done through a guarantee. It can be done through insurance. The other approach, which is not credit enhancement per se, in the traditional sense, is really to find ways to supplement the unsecured credit of the enterprise or of the country if there's a guarantee. And that's typically done by locating assets, financial flows in particular, which can be isolated, pledged, located offshore. And so if, for example, a country has a long-term supply contract or long-term supply contracts, plural, with buyers that themselves are creditworthy, that are located outside the country in question, and those financial flows can be pledged, the money can be paid, for example, through a bank account in London and New York and some jurisdiction which is relatively safe from a political standpoint. Then the risk becomes not so much a credit risk, but a performance risk. If the country or the state-owned enterprise is able to deliver the product, whatever that product may be, then you don't really have credit risk anymore if the legal arrangements are sound, because you're looking to the buyer's credit risk, and that presumably is of a higher degree of safety. And that's a typical approach. So on the other hand, there are countries that are not willing to do that. And to the extent they're not willing to do that, then it becomes very difficult. I was approached a couple of years ago by a country in English-speaking Africa that was starting up oil production. They had reasonably substantial flows, and they said, "Well, we're not going to tell you who our buyers are. It's none of your business." We said, "Well, but that's fine, but we can't arrange financing on the strength of the credit somebody we don't know who it is. It's just not possible." And they were adamant, and so we said, that was the end of the conversation, effectively. But it is possible, and it's not at all unusual to do that. The other alternative is to rely on the product itself. There are transactions, of course, where the financing is cast, for example, in the form of a advance payment for products. The product is delivered in the future. At that point, again, the risk is not so much credit risk, but performance risk. If the borrower can deliver the product, then you're not looking at the buyer's credit, you're just looking at its ability to perform and deliver. So I think those are the two approaches. There's a lot of rethinking, I think, going on now. And I think to a certain degree, the international organizations, the IMF and others, I think don't adequately understand that straight government credit should be dealt with differently from credit to, say, a national oil company. The national oil company, if well capitalized, and it can be well capitalized, it may not be. It may be a situation like Venezuela where everything's fallen apart. But there are cases where national oil companies or utilities or other state-owned enterprises are cash positive, and the extent that they somehow get swept up in a country restructuring without respecting the fact that they are in effect business organizations and that it's important to retain their financial credibility, you can actually have a better credit risk and a better experience lending to that enterprise, that state-owned enterprise, than to the government itself. There was a time, it's no longer the case today, in Mexico, for example, where Pemex had Mexico's state-owned oil company had a higher credit rating than the government. That's no longer true today, but when it was performing well and not overwhelmed by debt, it was viewed quite differently.
But from your experience, how can these projects, when the entity financed is an SOE or national oil company, for example, how can they isolate themselves from a state restructuring, a debt restructuring, and not be dragged into that process?
Well, I mean, again, to the extent that they have either long-term contracts or or customer relations that with a history that allows people to assume that the relationship will continue in the future, you can isolate through pretty simple legal mechanisms the cash flows that will come from production and use them to, in effect, to securitize payments. So many years ago, when I was practicing law, we put together a accounts receivable financing for Pemex. We did two. We did one that was done privately, where in effect, Pemex instructed its customers to make, and there were no long-term contracts there, but it instructed its customers to make payments for oil into an account identified account in the United States, and those monies were then dedicated to the payment of repayment of the financing. Similarly, Pemex, and then it was followed later by Venezuela in a time when PDVSA was a strong company, so pre-Chavez, created a vehicle that was a finance vehicle and literally sold forward future receivables to that vehicle. It was a US finance subsidiary, and they raised literally billions of dollars in the United States market on the basis of those of the contractual access to the future payments.
Mm-hmm. But in terms of government guarantees for these projects, I'm very familiar with the company, particularly in Africa, where government guarantees are no longer possible since the IMF provide support to that country. Is that, from your experience, is that pretty much the norm, that if you bring in the IMF, government guarantees are no longer available for state-owned enterprises?
No, I don't. I think it's not that strong, but there is I think the emphasis is more on saying to the government, if we're going to look at your liability exposure, we need you, first of all, you need to be transparent about what guarantees you gave, because in many cases they're not publicly known. Secondly, we're going to look at that and count that as part of your debt. So it's not so much, and there is a bias, I think, both inside the government and perhaps in the fund as well, but I'm not sure about the latter. There is a bias towards not having guarantees, but there are, oil companies are different. There are state-owned enterprises, frankly, that couldn't finance themselves without a guarantee, because if they're a state-owned utility that is in effect providing some sort of a subsidy, they may not have sufficient cash flow on their own or sufficient earnings on their own to pay their debt. The other risk, and I'll touch on it quickly, is political risk, because you can have all the best documentation in the world, and if the government says, if you don't have security arrangements, or if those arrangements can be interfered with, you're somewhat at the mercy if the government says, I'm sorry, I know we have a contract, but I'm not going to honor it. And there are a number of examples. For example, there's a lot of financing has been done in the case of oil and gas, where a portion of the revenues are dedicated to the financing, and a portion are paid directly to the government or the state-owned enterprise. And the portion changes with oil prices. So if oil prices go up, the government may get a larger percentage, but so may the financing may get paid more quickly as well, because you have higher prices. And I know years ago, I remember there was Occidental had this was not a financing, but Occidental had an arrangement with Ecuador, and it was poorly designed from Ecuador's standpoint, because when oil prices exceeded a certain floor, which is a number that today would sound ludicrous, was something like $8 a barrel, all of the excess went to Occidental. And Ecuador said, I'm sorry, we're not going to honor that contract. And Occidental said, well, we'll pay you $1 billion, now we can keep going. And Ecuador said no. And more recently, a group of people I know had a contract with a company, not in Africa, but in the Western Hemisphere, where there's a fair amount of corruption in the government. And they were told, you need to put some friends of the president are going to become your partners. They don't have to put any money. They're just going to be there to, quote, be helpful. And when the company said no, The response was, we've canceled your license. So these guys had invested $90 million and they now have, I guess, a lawsuit, but they don't have anything else. So you have to, and you know, one way to protect against that, frankly, is
well, there's insurance. There's insurance, no? There's
political risk insurance for sure,
yeah.
if you can get it, but absolutely. But the other is, and it's not a complete protection, but to the extent that contracts are fair and not emblematic of a great deal of overreaching, you have a better chance of someone not coming after you. If you have a contract that really is so one-sided that it's an easy target, then you're more at risk. But I agree with you. Political risk insurance, which can be privately or government organized. Governments issue political risk insurance. Western governments issue political risk insurance as well as do private companies. Is the more traditional way to protect against it.
Yeah. I would now like to hear your views on, there's this idea that hydrocarbon projects, particularly in Africa, they are very difficult to finance these days because a number of reasons, including the ESG movement, that of course is very much opposed to any hydrocarbon exploration. However, in preparing this conversation, I was looking at some actual figures, and I realized that in the last 5-6 years since the Paris agreement, and there's still hundreds of billions of dollars that are poured or allocated to hydrocarbon projects in Africa every year by the likes of all the investors, banks, private equities, money managers, you name them. You know, and actually, if you just look at the figures, the current levels are as high as ever there's ever been. So how do you reconcile the public discourse about hydrocarbon exploration in Africa in particular? It's a thing of the past in terms of financing versus these gigantic amounts of money that are still going into the places where hydrocarbons are taken off the ground.
Yeah, I mean, it's complicated. There certainly is more pressure through ESG, particularly with coal and some other things. It's pretty hard to say to an African country whose really major source of hard currency revenue is hydrocarbons to say, well, you got to get out of that business. I mean, you're telling the country to shut down, in effect. How is that country going to grow without it? Maybe they phase out over time and so forth, but I don't think the financing will go away. I think what's true, at least in the number of areas that a number of people I've been spoken to, is that there's a lot in the absolute amount of money may be increasing, but the amount of debt in relationship to equity has gone down, I think, significantly. And there are a lot of projects where you need a lot more equity as a percentage of the total cost of the project than you used to be able to do. You used to be able to, maybe put in 20% equity and 80% debt. And I think that's much, much harder today. But all the big firms that invest, take BlackRock, which is the subject of controversy about ESG today. As they point out, they continue to invest billions of dollars in hydrocarbons.
Hundreds of billions.
That energy transition is an important issue. It's actually something that my firm is doing a lot of work in, but it's transition. It's not tomorrow. There's no more oil and gas, and without financing, there won't be any more oil and gas to a degree. But I don't know particularly about Africa, but I think in many places the source of the debt has migrated. So you get strategic investors who will put up money where maybe banks are more reluctant to or under more pressure. There are private sources of funding which are less constrained by ESG concerns. But when we were trying to finance a couple of years ago a coal plant, which was not, which was an easy target, frankly, for ESG proponents of ESG. It was hard, and there were a number of banks that said, no, we won't touch it. Partly because it was a new plant and a new coal plant. And they said if you were a natural gas-fired plant or some other fuel or biomass, we would finance it, but we don't want to finance new production of coal. But even then, there were people who said, well, we can be helpful. We can be helpful. So I think there's no question that it's made it harder, but the flows have not vanished. But it requires, I think, more ingenuity. And maybe there are ways, I don't know, in particular cases, to demonstrate that that the money that will, for example, if you could demonstrate that the revenues that would be generated by the government or some entity through the production of hydrocarbons are going to be used to accelerate transition, are going to be used for carbon capture, are going to be used for other ESG purposes, I think that makes life a lot easier. That was one of the things we tried to do in this coal plant. At the end of the day, the government decided not to sell it, and so the project went away. But that was an approach that had some appeal.
Okay, yeah, that's interesting. If you and a country in one of these, well, in a low income country, say in Africa, for example, that is has no access to financial markets,
right?
And if the government of that country came to you and said, how do we get the financial resources we need if we don't access the financial market? Where can a really low income country that get money if not in the financial markets? If, for example, China is no longer available for that company, what does the government of that country do in practice?
I think you've got two sources. First of all, you have the international financial institutions. The regional development banks, the African Development Bank, for example, the World Bank, the IMF, the export credit agencies in various countries, various Western countries. You have sources of overseas development assistance, the IDA, the subsidized credit arm of the World Bank provides financing to countries without market access. The IMF, and there are a number of efforts underway to try to increase flows of funds. So that's one way. The other way is through non-financial sources, such as the oil companies themselves. The strategic investor itself, in many cases, put up money. Glencore, which is not a strategic investor, but Glencore, as we know, has lent a lot of money to African countries based on long-term contracts to supply
off-take agreements.
Right, and they lend to countries whose credit rating is they're not investor grade, to put it mildly. But similarly, ExxonMobil is in producing oil in the Western Hemisphere, in countries that are, really couldn't borrow in the market normally. And they're not borrowing; they're just investors are putting in money and in effect financing the project. So And again, and then the other way again is even if you don't have market access, if you can put together a good structure and create a securitized set of cash flows, then you can borrow as well, because you're not borrowing on the credit of the country. You're borrowing on the performance, the ability of the country to perform, and the credit of the off taker, if you will. So I think those are the three sources, really.
Okay. Well, but of course, every money you borrow, you have to repay it eventually. So
Or not.
or not. We'll get to that sometime. Yeah, we'll get to that part definitely. And and of course, you can borrow at one rate, and then rates go up. Someone at the Fed in Washington starts to raise rates, and the rates go up. So I wanted to have your view, and we are now interest rates have of course increased significantly over the last months. This must be putting a lot of pressure on the companies, on countries. And to face repayment of interest of their debts. What do you think? The other day I was reading actually, I think it was the IMF that said that 60% of low-income countries are either already in debt distress or at a high risk of debt distress.
Right.
60%, which is huge. So it seems there's this wave coming on these countries. How do you see in the next few years, assuming, of course, that interest rates are going to stay very high, that the war in Ukraine is not going to resolve quickly, and all the geopolitical events that we are facing? How do you see these countries navigating this situation in the next 2 to 3 years?
Yeah. Well, it's not easy. On the one hand, almost all the borrowings by countries these days are fixed rate. So it's not so much an issue that when the Fed raises rates or interest rates generally internationally go up, that your interest bill goes up day by day. That's the case of the U.S. government, which issues short-term bills literally every day. On the other hand, you have to refinance because interest, if you're lucky, you have a primary surplus and you can pay interest out of government revenues, but countries are not reducing their indebtedness today. So when principal becomes due, they have to go back into the market or go back somewhere. But remember that for the lowest income countries, they have more debt comes from the official sector, and it may be debt at concessional rates and less private debt. To the extent there's private debt, there's a problem. And you may have to restructure that debt and try to, in effect, get relief from creditors, and that happens. But the IMF and the World Bank, and really under the aegis of the G20, have been working to try to find ways to help low-income countries. And the two initiatives that they put together a couple of years ago, the so-called Debt Service Suspension Initiative, DSSI, and in April, and then in November of 20, the common framework, were really only made available to the 73 lowest income countries, plus Angola, by the way, which was added, even though they were not on the list of the poorest countries. And so that was a way. The common framework, frankly, has not been a success. I mean, not a single country has yet completed a restructuring under the common framework.
Why is that? Why is that?
It's for a number of reasons. First of all, I think it's a really poorly designed program. I'm actually the Bretton Woods Committee is about to publish an article, a paper that I'm writing with a former colleague of mine, that details some of the failings of it. One of the failings is that it was designed to try to create uniformity among the official creditors and China, among others, has not been willing necessarily to play by the rule book that the West tells them they need to play by. It was done in a very, in my view, ham-handed kind of way, where there weren't consultations. It was just, we know how to do this, China. We've been doing this for a long time. So, so from now on, you do what we do. And the Chinese said, no, we do what we do. we have agreements. We expect them to be honored, and they prefer, for example, they don't like to reduce the principal amount of their debt. They would rather lend more money or stretch things out over a period of time.
So no haircuts from China.
No haircuts from China, and there have been real delays look at Zambia, which was the first country supposedly to restructure under the common framework. They haven't done anything yet. Chad is finally making some progress. Sri Lanka, who knows? Ethiopia, Ghana. And there are other issues in terms of getting the private sector involved as well, where the common framework really, instead of what I think the official sector should have done, which is to try to recognize that the private sector is a necessary participant in these efforts, both for new financing and for restructuring. Instead of trying to work in partnership, it was more a question of, we'll work it all out, we'll figure it out, and then we, the official sector, and then we'll tell you, the private sector, what you have to do. And not surprisingly, that didn't sit very well with the private sector. So there are a lot of questions of how it goes, how the process works, the sequencing of things, and the fact that it was not really designed with the real world in mind. I think it's part of the problem is you get politicians or people who might be extraordinarily talented macroeconomists, but they're not market people, and they don't actually understand how these things actually work. So, but that being said, during the pandemic, for example, at the outset of the pandemic, the IMF put in place a number of programs to provide rapid access to financing for low-income countries. And in distinction from normal IMF approaches, you could have access to these programs without having to go through a full-fledged economic program or financing program with the IMF, which meant that you could get the money a lot faster. You had much less conditionality. And so there were financing programs for people in difficulty right away. There were financing programs when commodity prices fall. And so you have exogenous shocks to the country. And then the DSSI, the Debt Service Suspension Initiative, basically said for a period of time, which was extended to almost 2 years, we'll refinance all of your payments. So everything that was coming due, principal or interest, over what was first 6 months and then a year and then extended again, would be refinanced at the existing contractual interest rate. The private sector didn't join. Not one private sector lender, as far as I know, went along with that, but the official sector did. And to the extent that, the amount of money was not great. I think it was only about $11 billion that was refinanced, but it was an effort. And I think there's clearly a recognition in the official sector that this is not working and that more needs to be done. And there is an effort to try to put things, to find ways to speed up efforts to help countries in distress. And you'll see with the paper that the Bretton Woods Committee will put out also talks a lot about private sector engagement and equal treatment of creditors, which is another issue because people say, well, if this group of creditors is excluded somehow, For example, in many cases, domestic debt is not restructured. So other people say, well, why am I taking a huge haircut? If these other people participated, the risk would be shared. So there are a lot of issues that I think people are focusing on now, and I hope it'll get better. But there's no easy answer as to how these countries can help themselves, frankly.
When governments, countries go into this, full restructuring process of, I guess they first approach the IMF because they need to agree some reform program with the IMF. But I suspect the very first thing is to be transparent about the total amount of your debt. And now you have a more diverse group of creditors, not
Right.
the private creditors, governments, states, multilaterals, China in particular, etc. So I guess on day one, when a government rings the alarm bell and says we need help, first thing is they have to be transparent and say, okay, this is the total amount of debt, including that may not be in the balance sheet of the state or the government,
Right.
maybe in the SOEs, etc. For example, in respect of debt to and liabilities to China, is that transparent? Do the other creditors, the private creditors, actually know how much a country owes to China?
In many cases, no. In many cases, not. I mean, I know there's one country in particular where in Africa, which like many African countries has a substantial amount of debt for China. And I knew from talking to the government and some of the SOEs, I had a sense of the magnitude of the debt, but that number was completely different and much larger than the number that was bandied about in the public as to what their exposure was. That, again, the Bretton Woods Committee published a paper that I wrote on transparency, and I agree, that's a critical issue. Even before you get there, the first question, I think, Rui, is that many countries are so afraid of restructuring, of the stigma and of the cost, and there is a cost, that they often wait way too long, and they continue to pay, with their last free dollars or euros, which they shouldn't do, frankly, and things get worse and worse. But you're right, they would go to the IMF, and to the extent they have private funds, they really should go to their private sector creditors as well. And if you look at the two recent restructurings that were done a couple of years ago, last year, Argentina and Ecuador. Argentina has a history of not being terribly friendly to its creditors. It kind of tells them what they have to do. Ecuador was much more open and transparent, said we need your help. And Ecuador got relief right away that enabled them to buy time. And Argentina went into default because the private creditors said, no, I mean, you don't come and tell us, what we have to do. Whereas Ecuador was much more conciliatory. But in the case of China, and frankly, some commercial banks from the Western banks as well, they may put into their loan agreements confidentiality clauses that say to the government, you cannot disclose this debt. Or take the case of Mozambique, where the country itself hid the debt. And had several $1 billion worth of debt that only came out by accident in a meeting with the IMF, where some IMF official looked at some numbers that the Ministry of Finance had put forward and said, so this is exactly all you owe, right? And apparently, I was told, someone from the central bank, whether the governor or someone else, said, well, not exactly. And then it turned out that there was several $1 billion, which for Mozambique is a lot of money, of debt. And it's a long story. But and there was wrongdoing involved as well. But yes, transparency is critical. How do you know what relief is needed? And how do you know who should be participating in relief and therefore how people are treated unless you know what the country owes and what,
Right.
and it's even more, and as you say, the heterogeneity of creditors has become a real issue today. It's not just bondholders. You have bondholders, you have banks, you have private investors, you have quasi-debt and quasi-equity.
Arbitration claims,
Right.
arbitration claims.
Arbitration claims, expropriation. I mean, Venezuela is a good example. Expropriation claims. Just people, commercial claims of people who perform services and are owed collectively billions of dollars.
Yeah.
So it's really, and to the extent they're not, big funds that invest buy bonds or banks, they don't have experience in this, and they say, no, we want to get paid. What is this? And so, for example, in Venezuela, you have ConocoPhillips being extremely aggressive, with some success, I might add, trying to get paid when they were expropriated, and bondholders kind of sitting there and not having received a penny since the end of 2017. So with roughly $60 billion of bond debt, it's probably double that today if you look at the accrued interest. So it is really complicated. And then contracts can be complicated. So if you look at a loan agreement, you're not necessarily seeing the whole picture. So again, there's a country that we advised some time ago. I was talking to them about how they might borrow money, financing it against oil sales. And I said, well, you have loans from China, and you have long-term oil contracts with them. So maybe you should repay the loan, and then you can get new financing against the oil. And they said, well, we don't really want to pay that loan because it's a much better interest rate than the market. And we said, really? Yeah. They said it's 300 basis points cheaper than what we're paying in the market. And I said, and what are you selling the oil for? Oh, we give them a discount of so many dollars per barrel. So I said, well, you're actually paying your market rate on the loan. You're paying it indirectly. So I think transparency is a real issue, and trying to figure out who should participate and what's comparable treatment. If I'm a lender and I have security, do I have to give the same discount or make the same offer of relief that somebody who's an unsecured lender, or if I'm if my assets have been expropriated or I have commercial claims, et cetera? It's really complicated. And I don't think, we don't really have, there are no good examples lately of trying to work that through, frankly.
And you've been, of course, you've seen and helped negotiate many of these loan agreements and other agreements. Would you say they are fair agreements to the borrowers, or they are somehow taken advantage of by the lenders? Because most of them are in a state of despair when they, when they sign these agreements.
I think, loan agreements from Western institutions that I've seen, and certainly bonds, I think follow pretty standard pattern. And they are not the place, I think, where you see a lot of overreaching. Was a study done, I think, last year by a number of people, including Anna Gelpern, who's a law professor in Georgetown, who looked at, I think William and Mary College as well. They looked at 100 loan agreements from China. And there are a lot of things in those agreements that are different from the agreements that Western export credit agencies or international financial institutions do. That report tried to, I think, give the impression that the Chinese were overreaching. I'm somewhat reluctant to reach that conclusion. They did what I think a prudent lender would do. with some exceptions. I mean, I think, trying to, telling the country that you can't disclose is not a good thing, but it's a different kind of overreaching. Telling the country that this loan cannot be restructured, I think those are meaningless clauses. They also say you're supposed to pay on time. So you don't pay, what's the difference? I mean, and then there are other clauses that are more political. But frankly, I think every government that makes loans is in a position to exert some sort of political pressure. Where I see a lot of overreaching are not so much financial agreements, but other agreements by multilaterals, whether they're license agreements, agreements to provide services, agreements to, by multinationals. I think they're often the country is not either not advised at all externally, and the people in the government who, and I'm not faulting them, just don't have the experience and don't know what market practices and what they should accept or not accept. Or they hire advisors who perhaps don't do a very good job. So there are a lot of examples that I've seen over the years, including not too long ago with another country, where I think the terms are really very one-sided. There's a lack of symmetry.
And do these agreements, at least the most recent ones, include climate disaster relief clauses? Is that becoming the norm, or?
Well, we're seeing that you see that a lot in the Caribbean, where because of hurricane seasons. I don't know to the extent they put them in non-financing agreements, but I mean, this is a different subject, right, from overreaching, but yeah, I think that's the whole notion of so-called state contingent debt, where the obligation of the country to pay can be modified because of exogenous factors that are not caused by some failure of policy or implementation by the country. That's particularly in the case of climate, it's becoming more prevalent. Whether economically, whether putting those agreements, those clauses in loan agreements is more efficient than buying insurance. I mean, it is buying insurance in a way, but it's not buying it from an insurance company. It's buying it from a bank, let's say, or bondholders. I think is an open question. But the notion that countries that have, that are subject to natural disasters, or other kind of exogenous should not have to pay, or should be given some relief is prevalent. There was and how that's dealt with is different. In some cases, there's a period of time where, in effect, payments can be postponed. They're not forgiven. They're capitalized, in effect, or they're just deferred for some period of time. In some cases, they can be forgiven, but then the interest rate of the loan will go up, obviously. And then one large investor put out a paper a few years ago suggesting that you wouldn't even have to limit it to climate. That if once during the lifetime of the loan or the bond, the country could come and say, I need to have a year or some period of time in which I can postpone payment. I don't know that that's been adopted. But it's an interesting area. There are questions in the market as to how those agreements can be valued, and how you price them in the market, because it's not clear how you do that. Although if you're an insurance company, you do price that risk. Obviously.
Sure.
But bondholders don't necessarily have the expertise to do that. But I think the IMF and the World Bank have encouraged people to look at it more closely. And there has been an evolution of these clauses over time. So I think they're generally accepted as something that will happen.
Mark, I know that the future is very hard to predict, of course, but if you have to make a guess of how many countries in the next, say, 2 to 3 years will have to restructure their debt, or countries that will even default, what would be that number? Would you say?
I don't know.
Well, I don't know names or just.
I don't know, but I think, look, I mean, partly it depends on what happens to the world economy over the next few years as well. So, which I am not, unfortunately, able to predict. I'm not sure anyone is, but I know I'm not. Look, I mean, I think the number you cited, which was an IMF number, I believe, of the countries in distress or at high risk of distress, is large, and yet the number of countries actually in default today is not huge, right? I mean, it's the ones I mentioned the other day: Zambia, Ghana, or default or about to restructure, right? Zambia, Ghana, Lebanon, of course, but that's, goes back some period of time.
Sri Lanka also.
Sri Lanka,
Yeah, okay, yeah.
right. But I don't know that there are. I mean, Argentina is perennially in difficulty, but I don't know that there's a large number that will need to actually restructure, or much less default. But if interest rates continue high, if we enter in a period of recession, if for some countries who are exporters of commodities, if commodity prices tank, or for countries that are importers, for oil example, if oil prices soar and they can't afford it, energy, then the situation will change. I mean, in the 1980s, we had, a real series of a decade of most countries in Latin America running into difficulty. A number of countries, I mean, I did work for Ivory Coast and for Republic of Congo at the time, but there were others. And Gabon had problems, and Mozambique had problems. South Africa, has a huge amount of debt in ESCOM that the government's taking over, but let's see whether they can actually pay it. So I don't know. It could be. I don't think we're going to see a huge number of countries in difficulty, but it could continue a little bit of a modest stream every year. But we'll have to see. I don't know. There are too many variables to predict.
Okay, Mark. Well, we are nearing the end of our conversation. I would like now to give you the opportunity to talk a bit about your firm, Guggenheim Securities. Please tell us what Guggenheim Securities is, what you do, what your job is actually in day to day. So if you could speak a bit about that, so we can close.
Let me talk first about the firm rather than my job. The firm's a little more than 10 years old, but it's grown dramatically over that period. It has a broad spectrum of services, financing in the private and the public markets, M&A, restructuring, energy. We have a large energy practice centered in, but not exclusively, in Houston. And in fact, the firm has somewhat countercyclically invested a lot in that practice in recent years, and added significantly to the number of people that are working there. More recently, there's been a real track record of success in all of the energy transition areas: renewable power, carbon capture, CCUS, renewable fuels, advanced nuclear, climate tech, and mobility. And we do that with the help of product bankers in power, energy, industrials, private capital, and structured products, and asset-backed securities and the like. So, as an example, I think in the last 3 years, the firm has done more than 75 M&A and capital raising transactions for energy transition companies and raised more than $20 billion of public and private capital for renewable energy, electric vehicles, renewable fuels, and advanced nuclear, where actually the Guggenheim has experience not just as an advisor, but also as an operator, believe it or not, because there's not going to be global zero carbon electric grid unless we have a carbon-free baseload generation capacity, of which nuclear is one of the main potential sources.
Of course.
And we also advise the larger. I mean, today the smaller companies, frankly, it's harder for them to raise money. It's partly ESG, but it's also credit, because the spreads between investment grade and non-investment grade have widened significantly, and interest rates have gone up. So, but in the case of the larger companies that have competitive strength and a lower cost of capital and stronger balance sheet, Guggenheim has done more and more work with them. So what I do is at Guggenheim is to focus on international transactions in various areas, including energy and climate-related matters. And most recently completed a restructuring of the liabilities of Garuda, the Indonesian state airline, where we reduced their liabilities from 13 billion to 5 billion. So they had but every airline during the pandemic was under enormous stress. So I did that, and then recently worked on another transaction involving a company that was going to give energy transition advice and carbon capture advice to a developing country that has lots of potential, but hasn't really done anything in that area at all. So that's a pinpoint analysis, or not an explanation, if you will.
Yeah, thank you, Manuel. I'm sure you must be very busy in this period, and a lot of people and companies and countries and others will need your help and your assistance and your experience. Mark, we've come to the end of our conversation. I promise you that we would be finished by 9:30 at New York time. I'm just 1 minute late. So
pretty close.
Very close. And thank you very much for making yourself available in your time and for participating in the discussion. It was very interesting. I certainly learned a lot. And I enjoy the rest of your day and the weekend that's coming. And I hope we can see each other in person soon, somewhere.
Thank you, Rias, and thank you very much for inviting me to participate. I enjoyed our conversation a great deal. Thanks a lot.
Okay, thank you. Goodbye, Mark. Thank you.
Goodbye.
Goodbye.
Take care.